In a regulated market, you can't go global. You have to go regional to go global.
Hello, everybody. Welcome to Value Tokenized. This is Masha and I'm Xenia. Our guest for today is Kevin Murcko, CEO of CoinMetro, Estonian regulated crypto exchange. Kevin has over 10 years of experience in finance and trading, and he works closely with Estonian government at the moment. Today, Kevin will tell us about the advantages of Estonian regulation for tokenized assets, the main benefits of asset tokenization, and do they work at the moment, and why you have to go regional first to go global. Hi, Kevin. Thank you very much joining us here at Value Tokenized. It's a pleasure. Can you tell us more about yourself and about the project that you're working on right now?
I've been in some type of regulated financial industry for the past about 20 years. Most of that experience is in the retail FX industry. So lots of parallels between Forex and crypto. As you may or may not imagine, they're very similar industries, very similar client bases. I own and operate a retail FX platform called FXPig. It's been operational for about a decade. It's regulated. It's regulated offshore, but it still is regulated, and we've been in a regulated market for probably the 8 of those 10 years. Now, at least on the crypto side of the business, I operate several different businesses. One is called CoinMetro, which is the nice logo you see on my chest here, which is a crypto exchange combined with a challenger bank, combined with multi-asset trading. I also have the European Crypto Association, which is an SRO, or a self-regulating organization that looks to lobby across Europe, not just for tokenized securities, but for all aspects of crypto, to really help regulators understand how the market works, how it functions, what's missing, what we need from them, and what they should be asking of us. And involved in some other projects in different shapes or forms, from consulting, and I do a lot of speaking, frequently on tokenized security topics, ICOs, IPOs, IEOs, all those many different topics. But at least for the last few months, as I'm sure you guys know, there's been a lot of, let's say, a lot of interest around tokenized securities, or STOs, as they're referred to commonly in the industry. So that I've spoken a lot about that at different venues across Europe and outside of Europe as well.
A lot of benefits of security tokens, of asset tokenization, are being discussed right now, like global liquidity pool, and then there's opportunity to access, to transfer the funds anywhere across the globe. But right now, they remain only potential benefits. So when do you think we will see them coming to life, actually, and if this happen anyway at all?
I agree with you. I think there's 3 main benefits for the tokenization of any asset in my mind. And one of those is secondary market liquidity. The other one would be transferability, instantaneous transferability of ownership. And the other one is negotiability across borders. So unfortunately, right now, none of those are possible, like you said. The market liquidity will kind of work itself out. Why? Because obviously many market players now are going, looking to apply for and receive MTF licenses in Europe, which is multilateral trading facility, which basically allows you to trade unregistered securities. So those licenses have been around for decades. Before, the last time they were really utilized was during the junk bond market. So late 80s, early 90s. Since then, there really hasn't been any unregulated securities that anybody really felt like trading until crypto came along. So ATS licensing in the US as well, similar structure as far as the MTF licensing goes. But again, they've been around for quite some time, but many market players are now looking to acquire those licenses. So eventually there will be a secondary market. The question is how big that secondary market will be. Obviously, it has the potential to be much larger than the current market cap of crypto assets in general, but will it? So that's a question. And there's many things that need to be created in order for that to work, like CSDs, custody solutions, just to name one, but there's many more that need to happen. But the other things I think people aren't really focusing on, and that's a problem. So the real thing, to be honest, what really is needed, because when you talk about secondary market liquidity, obviously the initial market is not going to be as large. Let's say if you're tokenizing Apple stocks, well, there's way more liquidity in the primary market for Apple stock than there would be on a secondary market initially. So why would anybody do it? So that's not really, that benefit comes after we get transferability and negotiability. So how do you get transferability? You need a way to track ownership of this asset, and it needs to happen in real time. So that either needs to happen from a protocol, a protocol that's developed that allows you to have immutable data. So all the data that should never be changed, such as the structure of that asset, where that asset comes from, et cetera, the smart contract. Then you need to have mutable data, which is the ownership data. That needs to be mutable, it needs to be changed, it needs to be able to be changed. And the problem here is that in stocks, let's say, you can only buy and sell one Apple stock. You can't buy a third of an Apple stock. It doesn't work that way. But you can buy, out to 18 decimal points, a tokenized asset. So tracking of ownership is a huge issue. And there are a few protocols that are starting to look at it, but it's not really the thing that makes the news. Everybody talks about the liquidity and the MTF licensing and the exchanges and blah, 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 blah. But that really is the small piece of the puzzle. So I think, to be honest, that we're probably looking, aside from the regulatory aspects are already in place. There are regulations across every major region for securities. And there's no reason to make new regulation for tokenized securities, because all the token does is add those 3 value points. It does not change the structure of a security. It's still a security. Security is a security is a security. So new regulation is not required. MTF license, ATS license will cover basically what is needed. But those 2 other things are going to take more time. So I think from a development standpoint, to create a protocol will probably take somewhere between 6 and 12 months before we see any type of, let's say, initial standards for these type of protocols. The other option is to make a centralized repository. But obviously the word centralized in crypto is not one that's received happily. So that's probably not the way most people want to see it, though Germany's already working on it. So Germany's already working on a structure to create basically a centralized repository of data that can be adaptable to blockchain. So they're probably going to do it. I have no reason to think they're not going to do it. But in Germany still, there's laws on the books that say that a transfer of an asset or an asset actually isn't owned unless you have a printed copy. So you have to, so even though you'd have this, nice little token sitting somewhere in the blockchain, you would have to have a printed stock certificate or an asset certificate or a bond certificate that actually, so the token kind of becomes a coupon and not really the actual asset. So anyway, I think, to be honest, we're probably somewhere in the realm of 12 to 18 months away before we really start to see any type of growth, real growth in the tokenized security market. And I don't say STO, because there is no such thing as a security token when it comes to legislation anywhere in the world. There are guidelines. There are lots of people talking about security tokens as a moniker, but they don't exist, literally don't exist on paper anywhere when you talk about legislation. So I think tokenized security is actually a much better way to describe them, because that's essentially what they are according to current regulation.
Do you think there is some specific standard that suits best for like ERC, like 884 or 721?
I think, to be honest, I think we're going to see a very segmented market moving forward, where I don't think we have a standard for anything yet. I don't think we actually have a cryptocurrency yet. I think they're all crypto assets. I don't think any of these assets have proven to be a currency. I don't think we have any standard for, let's say, a blockchain for payment remittance. There is no standard yet. Everybody's fighting to become the standard. And I think because the market's so segmented, we're probably going to see, this doesn't happen. This happens in every industry, to be honest. There's always more than one standard. And then eventually one gets adopted or mass adopted, and that becomes the true standard. So you can see that in tech all the time, right? I can remember mini disc players. You guys probably don't remember those. Or Betamax and VHS and all these different things. So there's always going to be multiple standards before there is one true standard. So to be honest, I think Ethereum, for example, obviously was the first smart contract platform. It still remains the standard right now as far as smart contracts go, and tokenization in particular. But to be honest, I don't think it probably will retain that crown over time. Mainly because when it comes to the way there's better ways to structure the overall tokenomics on a platform than Ethereum has done. And I think other platforms have already started to kind of amend those flaws, but they're not yet there yet either. So I think initially Ethereum is going to be the winner, because that's where most of the tokens sit now. They have more, they're looking at different protocols, like you mentioned, 721, 223, obviously ERC20, the original protocol. So they will probably hold the crown for now, but I don't think they'll hold the crown forever. I do think that something will emerge. And in finance, for better or worse, the larger players or the power players generally remain in power, right? So the power players that exist today have been in power in finance for 200 years or more, 300 years. You can go back even further than that. The powers that be tend to remain the powers that be. So you have to see who's really going to push the narrative to create these standards. Is it going to be a private foundation? Is it going to be some type of blockchain protocol with a lot of really smart guys that know how to code? Or is it going to be the guys that sit where the money and the power is? Will it be, NASDAQ? Will it be the FTSE, the CAC, the New York Stock Exchange, et cetera, that put the money, the power, and the connections behind to create a standardized protocol? That question remains to be answered. But to be honest, I think the standards we have today, or the protocols we have today, probably will not be, in all aspects, the standards that we see once the market actually hits, let's say, true mass adoption.
Don't you think that institutional players like NASDAQ, for example, or SIX, who are also entering this market right now, have more advantages over some smaller projects?
Many aspects they do, but in like in any industry, right? There always is room for someone that does something a little bit better. So I think you don't need to do things that much better in order to gain market share, especially when you ask people about, especially in finance, right? If you ask people, I don't know, what is your opinion of banks? I think 9 out of 10 people, probably 10 out of 10 to be quite honest, are going to tell you they don't like banks, that they think they're thieves and they should go be in jail and blah, 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 blah. And if you ask the same thing about most things in finance, so your broker, do you like your broker? They're going, nah, they charge me too much fees. Do you like the platform you use? Nah, it's too slow, or whatever. There's always going to be complaints. People, when money is involved, especially direct, money's involved in everything, but when it's directly involved with money, people complain about everything. So I do think that they have an advantage to the point, and they have a disadvantage. So even in my case, so we're a regulated, we have a regulated exchange as part of our ecosystem. Obviously, there's players like Binance who are completely unregulated, and obviously they right now have an advantage because they're unregulated. They can pretty much do what they want. So they can list any asset they want. Doesn't matter if it's a security, not a security, a bond, a debt obligation, doesn't matter what it is. They can list it, they can offer it to the public, they get the volume, and everything looks great. Obviously, though, as we move to a regulated market, they will be at a disadvantage. So right now, while there are a lot of smaller players trying to do things in this market, some are doing it outside of regulation, which gives them an advantage. Some of them are doing it inside regulation, but not the same regulation that NASDAQ has to follow, for example. So NASDAQ has to remain inside quite a small box to be able to do their R&D, find products, release them. It's actually not that easy. However, once the regulation touches everyone, obviously they will have an advantage because they will already have the tools in place, the market in place, the client base in place, et cetera. So it really depends on between now and when the real regulation hits everybody, who really creates kind of, it's not so much the size of the market they create, it's about the tools they create, the services they create, the reputation they create to see who will actually garner the business moving forward. But you're right. I think there's disadvantages and advantages to being someone like NASDAQ right now in this market. And a lot of that is because of regulation.
And talking about different regulations, you're based in Estonia, and that's like the regulation that like your exchange, your ecosystem falls under. And can you tell us a little bit more about like its specifics and especially this regulation's attitude towards tokenized assets and tokenized securities?
We're based in Estonia, that's true, through the European Crypto Association and also with CoinMetro. I've talked to regulators in, 12, 13 different countries. And on the FX side, I've talked to regulators, I don't even remember the number, maybe 30 or 40 different regulators over the course of 10 years. So regulators have a lot of things in common, regardless of where they're from. Here in Estonia, the government, as far as the government as a whole, is very well receptive to tech, right? They've built a reputation. I think there's some statistic out there that there's more tech unicorns here per capita than anywhere else. Obviously, it's a small country, so you could have 2, and that kind of gives you per capita bigger than anywhere else in the world. But they are very well receptive to tech. There's a lot of tech companies that come here. There are some large players that have started or remain here, Skype, TransferWise, Pipedrive, et cetera, et cetera, et cetera. So the government itself is very well receptive. Regulators, however, are never that receptive, especially when it comes to new technology that touches money or touches investors or touches especially retail investors. So because there's never really been anything in finance that's such a hybrid model that you can have one particular asset kind of be more metamorphosized into 7 or 8 different assets over its lifetime. As you offer it as let's say through an ICO, it becomes a security. After that, it has a utility. After that, it may become some type of derivative, or it may become a future. This has really never existed. So these type of things, they're reluctant. They're not as reluctant as other regulators. They're, I would say, more open. It is a small country. It's easier to talk to people. If you want to talk to the Minister of Finance, you probably just have to ask your neighbor, and it's probably the guy's uncle. I mean, there's literally 1 degree of separation. So it makes it rather easy to connect to people and to be able to talk to people. Whereas in the UK or in the US, if you want to speak to the chairman of the SEC, pick a number, wait in line, and you probably won't talk to the chairman of the SEC. So there is more access here. They are open. However, they're still on a learning curve. There still is a major learning curve for regulators to understand. They did go in the short time we've been here. We've been here about a little over a year. We've already helped the Minister of Finance redraft laws around their own licensing, the FIU license, which is the license that we hold here in Estonia, which allow crypto to crypto and crypto to fiat exchange, along with custodial e-wallet services. And we've helped them redraft those to make it more strict, because basically the licenses were just too easy to acquire. And that was actually passed by Parliament. And we've only been here a year, and we were able to do that. And that's mainly because we just showed up at the offices a few times and kind of annoyed them. And then eventually they said, "Hey, you want to help here? Here's a draft of a new proposal. What do you think?" And we rewrote the whole thing, and they actually accepted it. So these are kind of things that you don't really see elsewhere. But on a broader scope, to be honest, I think when regulators in general hear the word crypto, they tend to overthink. So, all the assets that exist in the crypto realm, even though they can, one asset can have multiple classifications over time, all these classifications already exist. I mean, there's no real reason to write new regulation. There's only a real need to understand the assets that you're trying to classify and classify them. There may be a need for some type of hybrid clauses in between different asset classes, where it's something, when it's offered to the public, depending on how it's offered, it could be considered a security, so it falls under one specific regulation. After that, however, if it doesn't have any qualities of a security, then it should be no longer labeled as a security. So there are certain caveats, but to be honest, I think that it's very much overthought. And actually, I think it was 4 days ago, the 22nd of March, that Switzerland actually came out and said they were finally going to basically take crypto assets, or at least some pieces of blockchain as far as legislation goes, and apply it to existing regulation, which is what everybody will do. Mark my words, at some point there won't be a lot of new regulation created. So yeah, here in Estonia, they're receptive. I would say it's one of the better places in Europe. One, because it's small. Two, because they kind of felt a little bit of fire. They felt a little fire recently. Obviously, you have the Danske Bank thing, which obviously wasn't the best PR. Before that, you had this Estcoin that kind of got them in a bit of hot water with Mario Draghi and the European Central Bank. So they're kind of used to a bit of controversy here. They're a little weathered because of it, but they're open to try and kind of push ahead and become, maintain this, tech center, tech epicenter in Europe. And because a lot of tech now is being done on the blockchain, and blockchain is kind of a keyword when it comes to fintech now. Again, the government is pushing, and I think even pushing the regulator to try and understand, adopt, and really kind of be a little more open to these type of projects and businesses.
Talking about securities legislation in Estonia, what are the main restrictions? So how are the issuers of securities limited in terms of selling?
Well, in Estonia, it's the same thing as it is in all Europe, right? So it's under MiFID II and ESMA. So it's the same directives as everybody in Europe faces. Obviously, each country can have some caveats here or there. In comparison to the US, Europe has a much more black and white definition of what a security is. So in the US, you have your famous Howey test, which basically says, if you buy something and speculate on price, it makes it a security, which basically gives the regulator the power to say anything as a security. Because I can buy, an apple at the grocery store thinking I may be able to sell it outside for an extra 20 cents, and that theoretically would make it a security. We all know apples aren't securities, at least not physical apples you can eat. So in Europe, the definitions of securities are there's a list of requirements. They're very black and white. There's really not much gray area. So at least in Europe, and Estonia is no different. So Estonia doesn't have any different requirements than anywhere else in Europe would have. They're pretty much standardized. I think at least from a crypto standpoint, the biggest thing obviously are the, let's say, the things that stand out the most. So you're not paying dividends, you're not giving access to voting rights. The token itself doesn't actually, if you make any type of, let's say, bonus or something from using the token, it has to basically come from your usage. Meaning that if you buy a token and some other user does something and you make a bonus because of that, that would make it a security, because you're basically benefiting or profiting from someone else's work, which then would classify it more on the security side. But it's I would say easier to be able to structure something in Europe on a whole. If you're looking to structure something that you want to structure some type of new token type, and you had to choose between the US, for example, in Europe, anywhere in Europe, to be honest, it would be easier in Europe. That's for sure, because it's just more clear cut. The US guidelines are vague, very vague, and they're done like that on purpose, obviously, so that the regulator has the power when they see fit to deem almost anything a security. Here it's a bit different. It really does have to be a security. It has to have telltale signs. So again, dividends, you're giving some type of rights or access, rights to voting rights, for example, inside a company. You're paying some type of profit share, revenue share, or you're profiting off of the work of others by owning that token. Outside of that, you're pretty much on the safe side in Europe, Estonia included, obviously.
And do you see interest from investors, the European-based investors, like both accredited and retail, or it's mostly interest coming from other regions like US as well? So what's your thoughts on this?
Well, when it comes, I mean, obviously, when it comes to volumes or interest or anything, when it comes to crypto right now, because it's generally an unregulated market, most of the volumes, as most people know, come from Asia. Most of the interest, lots of interest comes from Asia. But and I take a caveat back to, or I take a look back at FX, because again, I do think these markets are, I mean, if you look at the history of FX regulation and look at what's happening in crypto, it's almost identical. And it was only about 20 years ago. So we're not talking about such a long time ago. But before FX was regulated, China and Asia specifically, but China was a huge volume generator of FX volumes. Why? Because China has historically had quite tight capital controls. Chinese, billionaires, millionaires can only move about $50,000 US equivalent out of China on a yearly basis legally. When they go above that, there's not that they can't go above that, but it basically implies taxes, and it implies lots of heavy paperwork, et cetera, that no one wants to go through. So obviously that's how Macau was born, gambling. That was one way that Chinese individuals were able to move money out of the country. That now crypto became, or FX at the time became, a way that they would be able to move money out of the country easily. And it became a huge volume generator. As soon as it was regulated, however, on a global basis, China gone. So now when you look at the top 20 countries in the world for FX volumes, China isn't on the list. Now, when you look at crypto, China is obviously, in Asia, has been historically the highest where the volume is. But the volume is there for a reason: capital controls. When regulation comes into the market, that's going to change, and it's going to change. You're basically going to see volumes go US, UK, Australia, obviously Europe, and then Brazil in South America. Those are going to be your volume generators, because they're your volume generators on every other financial market, and that's not really going to change with crypto. So I think at least for us right now, for us specifically, based in Estonia, our major volumes right now come from Europe. But it's also because we're working under regulation. So in a regulated market, you can't go global. You have to go regional to go global. You can't just open the doors to everyone because you're regulated. You have to deal with regulation, right? So you can't just, you can't open up for instance, you can't open up a stock brokerage in Germany and just onboard a bunch of US clients and a bunch of Chinese clients, which doesn't work that way. So it's the same thing will happen to crypto. So for us, we actually do business based on current regulation for other markets, and it restricts us a bit now. But I do think in the future it's gonna be a major difference between ourselves and when, let's say, the larger crypto exchanges and larger crypto companies that currently exist that have issues with regulation. They may fall, but those that are properly regulated more than likely won't. So I do think that we're looking at Australia, like I mentioned. We're looking at Brazil. So I think from a business aspect, in a regulated market, the only way to go global is to go regional. So right now, Europe is kind of what we're looking at, because that's where we're based. We have Australia for Asia Pacific, which will be a way for us to get into Asia, but still in an English-speaking country. It just makes it easier initially. Yeah. You have Brazil and Mexico, the first and second largest economies in Latin America, to break into the Latin American market, also under regulation. So yeah, I mean, if you look globally in the unregulated market, Asia's, when you talk about investors, when you talk about speculators, when you talk about retail, even when you talk about institutional, even when you talk about institutional interest in blockchain only, China, that's going to be your major push. Obviously, the U.S. is probably number 2 when it comes to not so much volumes per se, or even investor interest. There's a lot of investor interest, but investor money and interest are 2 very different things. But when it comes to interest from institutional players in infrastructure, which is really where the hype is right now, right? You have IBM and Stellar that just announced. You have JP Morgan with their JPM coin. You have lots of major institutions that are investing in infrastructure, not so much in crypto. You know, the main reason is because where do they put the money? The market cap is 140 billion. Where's the money going? You know, they're not going to go to Binance to buy Bitcoin. They're going to do it through some type of dark pool, and that dark pool is going to be limited in liquidity, and that dark pool isn't going to touch the underlying price, meaning the price won't rise, meaning the market cap doesn't rise. So it's a bit of a catch-22, right? You need retail money to create an institutional money flow. You can't have institutional money first in a new market. It just doesn't happen that way. Institutional money doesn't come in before institutional money comes in. You know, somebody needs to take the risk first. They can't take the risk if there's no liquidity, and the liquidity has to come from the retail side.
I think I probably have one last question. So one of our guests who recently announced one of the biggest real estate tokenization deals in the US. So he stated that probably the only benefit of asset tokenization right now, for them at least, is the ability to accept crypto assets as from investors. So, but the other opinion is that you still have to prove, to go through all the KYC, ML checks, and to prove where the money comes from. So in your opinion, do you think it actually serves as a benefit? And does it work this way?
So no, not a benefit at all. It's just compare the market caps. So compare the market cap of available US dollars to available crypto in the market. Remember that out of that market cap, that 144 whatever it is billion, or whatever it is today, 46 billion market cap, a vast majority of the Bitcoin, that's 50% of that, right off the top, 51%, is locked, and wallets have never been touched. So that market cap is actually false in many ways. And we really don't know the extent of the availability of all that. So let's say the market cap is half that, it's 70 billion. That's your entire market cap. That's if everybody in the world with every available crypto asset invested in your project, you'd have access to 70 billion. You can get access to 70 billion in a 3 square block radius of Manhattan. So no, it's obviously not a benefit at all. Zero benefit. What I think the indirect benefit there is that there are people that hold crypto assets that don't have any of them that they feel would be a legitimate or a mature investment. So if you provide a legitimate or an investment that can provide legitimate returns that are sustainable, then yes, it opens the door to probably a good percentage of that available crypto where people are actually looking for mature investments now. Because I think a lot of people in the crypto space think they're traders because they bought at 600 and held, and now they think they're traders. And they're now realizing they're not traders as they lose money every day and lose their shirts. And I think that quick maturing of thinking you're a trader to actually going, I'm not a trader at all. And now they've while they may not be accredited investors yet per se, they definitely learned a lesson. And I think they are starting to look for more mature investments. They're not trying to find the next ICO that's going to go to the moon, so to speak. They're saying, well, look, I made a bit of money. Where traditionally can I put this money that actually makes returns over time? Obviously, real estate is a place that a lot of people think is a safe haven, and that's where they run. So in that aspect, I guess indirectly it's true, but accepting crypto to say that it's better than accepting traditional money is just ridiculous, because obviously there's way more traditional money in the world than there is crypto. Bar none.
Makes sense. Yeah, I think that's it. Yeah, that was our last question. But we actually have a lot more. But yeah, we'll maybe postpone it for another time if you will be up to that. To more talks in future. Yeah, and thank you so much for being with us at Value Tokenized. Thank you. It was our pleasure.
Thank you, guys. Thank you very much for the invite. Appreciate it.